You're buying and holding stock, you've got your capital at risk. And it's impossible to consistently predict the market. Nobody knows. If you could consistently predict the market, you'd have the highest paying job on Wall Street. And they pay quite a lot, in case you guys don't know. Okay? Nobody can consistently predict the market. And when stocks do go down, they stay down for a very long period of time. Okay, let's look at the Dow and the Nasdaq and the Nikkei. Buy, hold, and pray does not produce a regular monthly cash income. Buy, hold, and pray does not produce a regular monthly cash income. Buy, hold, and pray simply means you're buying the stock, holding it, and praying that it goes up. If it doesn't go up, you don't make money. Sounds like a bit of a loser's game to me, right? Okay, so the protected trader, this is what we do. We buy stocks and protect them for a limited risk. So we set our maximum risk in the asset of 2 to 7%. That's our maximum risk. Then we use our cash flow generation strategies to buy the stocks and ETFs and generate what we call our super dividends. You're generating up above and beyond the dividend on the stock in terms of a cash flow on the stock, so that you're overall, over a period of 2 years, paying off that asset as well. Once you start generating your cash flow, you start reducing the cost basis in the asset automatically. So after a while, you won't need the insurance that we're using. So investing for income in ETFs, REITs, MLPs, and royalty trusts for monthly cash income. Now, we're going to talk about ETFs today. Does anyone know what ETFs are? Exchange traded funds. We're going to talk about them because they're very, very, very good ways to reduce your risk in the market. It provides you instant diversification in the market. Okay? And the protected trader limits your risk and generates cash flow. That's it. We get paid to buy every stock with our downside limited. Simple. Now, compounding. 4% net return. Who's this guy, by the way?
Warren Buffett. Warren Buffett.
Wow, that was the fastest response I've ever. Okay. Year one, say you start with £10,000. After 10 years at compounding at 4% per month, a £10,000 or $10,000 investment would yield you about 1.1 million. That's the power of compounding. How do you think Warren Buffett has managed to keep his wealth? Power of compounding. Doesn't take stupid risks, makes consistent returns. Okay? So yeah, 10k investment, 4% a month, £1 million in 10 years.
Anybody know what Warren Buffett makes on average for the last 30 years?
20%.
Every year? 21%. Yeah. Per annum. So he uses most of the strategies that we use. George Soros uses them, a lot of the fund managers use them for their own account. And it is so simple, and this is why he can afford to say, best time to be in the market is forever. He doesn't have to worry if Wall Street closes for 5 years. That's not how we should be trading. If you are trading that way, you're taking a risk. You're taking a risk that you're not comfortable with. Yeah. So our promise is to go into the market knowing Wall Street closes tomorrow, the maximum risk is 2%, 3%. So you don't have to rush in and get out of the market, etc.
Yeah, so 90% of the losses that are created on Wall Street is because of emotions. So we take the emotions out of the game because your risk is protected, your capital is protected. Once your capital is protected and your risk is secured to where you want it to be, your emotions come totally out of the asset. Okay, that's the biggest skill that you guys need to learn. If you've got pens, pads, write that down. Emotionless investing. That's the key. Okay? Actually, one of Warren Buffett's other points that he says is, I invest in companies that even an idiot could run, because one day an idiot will. Okay? It's emotionless investing. It's simple, it's proven, the strategies that he follows are there, that's, it sticks to them, that's it. Now, buy and hold strategy, buy the stock, hope and pray that it goes up. Nobody knows what the stock price is going to do. To make money, the stock price must increase above the purchase price. This is for those that haven't invested in the stock market before. and then the stock must be sold at that higher price to actually realize the profit. There's two if scenarios there. It's firstly if the price goes up, and if you don't sell at that higher price, no profit is generated. No profit is generated. Okay, problem is most shares trade sideways for long periods of time, or they move up and down in a tight range, and try timing the market. You'll be out of it quicker than a person out of a burning building. I was going to think of something better to say there, but completely forgot. So, buy and hold does not produce an income. It actually costs you money when the shares stay flat. Why? Number one, because most people borrow money to invest in the stock market. It's not their cash. And even when you're borrowing money and the stock's staying flat and it's not making you money, even when you're not borrowing money, when the stock's staying flat, you still got, even if you count in inflation, it's still going to cost you money. Not to mention the opportunity cost on that money. The other business, the other stocks that you could have got involved with. And world events affect local markets, and it makes markets very volatile. Okay, if we have another terrorist attack, the market's going to go nuts. And then there's market manipulation by hedge funds, Wall Street scandals, etc., etc. Who's heard of Jim Cramer? Okay, if you haven't heard of Jim Cramer, do some research on him. He actually talks about how the markets, how the hedge firms manipulate the markets. There's a very, which website is the video on?
He's on YouTube. Everybody can know YouTube.
Yeah, so...
If you type in Jim Cramer, you'll get hundreds of videos. He does a daily program in the States on CNBC. It's about investing in the market and how not to really get scammed.
Okay. So, this is a 5-year Microsoft chart. Bottom line is that you've got to... This is where people get screwed up. They try and time the market. They try and get in at the bottom and sell at the top. Get in at the bottom, sell at the top. But how do you time that? Especially when you can't see the rest of it. I mean, what's going to happen there?
Microsoft is one of the most widely held stocks. And if you were in this stock 5 years ago, you haven't made a cent. The stock price is still trading where it is. You had your small dividends, and that's it. And you'd be surprised how many people own thousands and thousands of these shares just sitting there doing absolutely nothing. If they only used one of the strategies that we use, we would have paid for the shares over 2 years, and the shares would now be free, and they're still on the stock. So systems are really powerful. It's just a question of getting to know what is available. And unfortunately, Wall Street don't want retail investors to know this, unless you're a high net worth individual.
I mean, when we were in Dallas, there was a lady at the seminar who said, "I own some Microsoft stocks." I said, "Okay, how many do you own?" 64,000 Microsoft stock, because she'd inherited them. Okay, just one of the strategies had her an income of something like, what was it, $10,000 or something, and that was because she couldn't get $10,000 per month. She was just sitting on the stock, and she couldn't get rid of the stock because of the capital gains liability. Okay. Now, so why insure risk? That's all right. You got shocked. Did you see that? It's the effect our PowerPoints have on. Okay.
Just saw the price of Apple drop.
Apples. Who likes Apple computers? I love Apple computers. Okay. If you've got a PC, you guys just need to just buy some Apple computers. Okay. 100 Apple shares, $20,000 approximately. Apple can drop 70 points in 1 month. On 100 shares, that's $7,000. Now the question is, can you handle that? If you're Warren Buffett and you've got, 40 billion invested in the market, and your current valuation of your assets is down 20 billion, you still got another 20 billion to mess around with. It's okay then. You can sit through it. But the average retail investor can't. Okay? And